Well, going through my research yesterday, it came to mind that Prosus and Naspers make up 17%, just over 17% of the Aussie 40 index in South Africa. That is a huge weighting for a single stock. And if you think about it, a little bit like what the Mag 7 is in the S&P in the United States. So we need to pay attention when their results are out. Their results were out yesterday. We've got Best in the Business to explain to us exactly what they mean. And what I love about 361 is they don't follow the PR story. They're always looking at both sides of the coin. They, being a hedge fund, both will go short and long. So these are not nonsense stories that you're going to be getting. Stephen Hurwitz is a portfolio manager at 361 and the man who follows the whole Prosus Naspers story. Well, we're used to your colleague your colleagues rather, telling us that there's always a bubble to be pricked in the narrative. And I want to ask you straight off, these results for the 6 months to end September, were they a genuine turning point, which is what Prosus is telling us they are? In other words, their e-commerce is now starting to make money and the margins are starting to improve there. Or was this done through just a little bit of successful financial engineering?
Look, without a doubt, we've seen a huge improvement in Prosus's performance. But I think this improvement actually started last year. For many years, people bought Naspers and Prosus because it gave them exposure to Tencent, which is by far their largest asset. And that's a fantastic company. But all the other assets within Prosus and Naspers, there was a bit of a question mark. They didn't generate many profits, and the company had continued to spend capital on these acquisitions that weren't delivering for shareholders. But finally, last year, and the momentum's continued into this year, we're starting to see some of those e-commerce assets turn, and their revenue growth is fantastic. But pleasingly, there's profits that go along with that revenue growth. And now some of their largest businesses are profitable and growing rapidly. So this is great for investors. And over time, as those assets get bigger and bigger, we should see the discount to NAV narrow as it becomes a Tencent plus story rather than a Tencent minus story.
It's still a Tencent minus, though, at the moment, isn't it?
Yes, it is. It still trades at a discount, and a relatively significant discount to its net asset value, but it has come down since they implemented the share buyback. So basically what's happening there is that Prosus sells some of their Tencent shares and buys back Prosus shares in the market. And as a result, investors actually get more exposure on a see-through basis to Tencent, given that they're buying back shares at a discount to the Tencent value. And similarly, at a Naspers level, they're selling Prosus and buying back Naspers shares.
Okay, so all round, it's very rational, the approach that's being taken. And it's a big bet. In the press conference yesterday, the online press conference, Nico Milan, the CFO, said that they'd returned $42 billion to shareholders to date through this process. And in fact, in the past 6 months, it was another $4.5 billion. Those are big numbers that you have to wonder, when do they actually stop doing this?
Sure, I think that's the question that most people are asking, because the buyback is being funded by Tencent. And ultimately, if they follow this through to completion, there would be a point at which they lose, let's say, significant influence or a seat at the board of Tencent if they were to continue doing so. And I think that the proximity to Tencent by being on the board is a huge benefit for the company. They get to see trends, they get to speak to some of the best capital allocators in the business. And the last thing that they would want is to lose that access, in my view. So I think that's why you're starting to see the tone change a little bit in terms of they're going to slow the buyback down. They're going to have a look at selling other assets to fund the buyback. And to me, that's completely rational because there are many assets in their portfolio that aren't going to deliver the same sort of returns as Tencent. So why sell your crown jewels? Rather hold onto them and sell other assets that are underperforming to fund the buyback.
Robertson, a small town in the middle of nowhere where a wine farmer claims to have sold a Volkswagen up to WeBuyCars.
A farmer.
What car did you really sell them?
A VW up.
Right here in Robertson.
Small town, but we know about WeBuyCars.
Yeah, but what's a farmer doing with a VW up?
It was just a runaround.
Cool cover story. And I see you traded it in for this, like a double cab Dene. Well, were they all out of ranges?
WeBuyCars, the easiest way to sell your car by far.
Can you tell us of any of the assets that stand out as potential sales? We have had the sale of Meituan in most recently, and maybe you can tell us a little more about that as well, because this is going to be a big story for them going forward if they're going to hold on to their Tencent shares, but they still want to close that discount.
Sure. So I think the Meituan sale will continue for the foreseeable future. They only sold a portion of it in this last period. Meituan is a food delivery business based out of China. And I think that they also felt like there was an advantage to holding shares in Meituan. And they were able to see what the strategy was for how Meituan got the most out of their food delivery business. But Meituan's now entered into Brazil, where Prosus has a huge food delivery business there, iFood. And I think given the competitive dynamics, it doesn't really make sense for them to hold on to shares in their competitor. So that will come to market over the next couple, or they'll be selling that into the market over the next couple of months, I would assume. Another business that they forced to sell is Delivery Hero. So that's another food delivery business. When they made the acquisition of Just Eat Takeaway, one of the conditions in terms of the Competition Commission in Europe was that they dispose of their Delivery Hero shares until they have a low single-digit shareholding. So that needs to be done. I think it's by August next year, and that will be another area where they fund the buyback from.
There was a line in the accounts relating to Delivery Hero. Can you unpack that for us?
I'm not 100% sure which line exactly you're referring to. But
the losses, yeah. Mm-hmm.
Okay, so Delivery Hero is a listed company, and it has struggled in some of its core markets. So I think that they're now crystallizing some of the losses that they have on that holding because they bought the shares much higher up. They paid a lot more than what the shares are currently trading. So now when they sell those shares, they are effectively crystallizing those losses. But I don't think that as a management team, you can look at what the previous management team did or what they paid. You have to look at it with a fresh set of eyes and do what's best for the company going forward. And in this case, it would be to sell Delivery Hero. It is a pity that they are forced to sell it because I think there would be a great argument to be made that Prosus could be a consolidator of food delivery businesses globally. And if they were able to hold on to that stake, then maybe there'd be another transaction down the line where they could consolidate more of these businesses.
So they made a bet then on Just Eat Takeaway, a company that they had a run at a few years ago. They managed to get it a lot cheaper this time round, but it's still 5 billion euros, lots of money. What's your assessment of that deal?
So I think this is going to be the CEO Fabrizio's big test, and I think there's going to be a lot of scrutiny on it by the market. Obviously, given the previous management team's value destructive acquisitions, there's going to be extra scrutiny on him. But because he comes from iFood, that was his business, there is this belief that if there was ever a business that he understood and was able to acquire and extract value out of it, it would be another food delivery business, specifically in this case, Just Eat Takeaway. The company is in a tricky spot. The fundamentals don't look like they're going well. But I think that's the opportunity that Prosus sees. And they believe that they have the playbook from iFood, and they can roll out that playbook and turn around Just Eat Takeaway's fortunes. That's going to be the big question. And if they do so, I think you'll see the discounts to NAV narrow even further. And if they fail at it, I think we're going to go back to where the NAV discount to NAV widens.
That's a very interesting point, because there are many people who visit London and they're on the tubes, and you can see on the tubes Just Eat Takeaway adverts pretty much everywhere. So it's got a very big presence in the UK. But where else is it present?
So they have the other significant markets are in Europe, and I think that speaks to the idea that Prosus is trying to create an ecosystem. So they've got their LATAM ecosystem. I would say that ecosystem makes the most sense. So there's iFood there. They've bought a business, Despegar, which is like an online travel agent, and they believe that they can integrate the two and get some cross-shopping, and some of the people who weren't exposed to the one platform will now be. I think that makes a lot of sense. Whereas their ecosystem plans in Europe and then in India are a little bit more stretched, especially India. So this is definitely a step in the right direction if you're trying to create an ecosystem in Europe. The problem is, I don't know how many people are cross-shop for like on classifieds and then for food delivery. But let's see, let's give management the benefit of the doubt. I mean, this is Fabrizio's bread and butter, food delivery. So it will be interesting to see how they execute.
Fabrizio Bloisi, the gent that you've been referring to a couple of times, is the relatively new CEO. He is the guy who founded iFood, which is a huge success, the star of the whole show. So not surprisingly, when they dispensed with the previous management, they looked at somebody internal, and he was the guy who got the nod. How's he done so far since, how long is it now? 16 months since he's been in the hot seat.
So I think he's been a fantastic hire. You can see that they went more for an operator than a financial engineering type of individual. And that's what the business needed, because they needed someone who would get these businesses to grow their top line, improve their profitability, etc. Speaking to Fabrizio, you can just see how he's re-energized the organization. I think it's very easy for him to get people on his side in terms of the vision and what he sets out to deliver. But I also think that he's very firm in his approach. If people aren't delivering to his expectations, I think that he is able to address that relatively quickly. So I think Fabrizio's done an excellent job. He's obviously incentivized extremely well via his moonshot pact to do so. So that's if the market cap of the company doubles since he joined, he'll get a very significant payout. But he had one of the hardest jobs, to be honest, because in order to deliver value in this business, you needed to have both Tencent doing really well, which is actually out of their control. But you needed to be able to do acquisitions to grow the rest of the company so that Tencent doesn't dominate it in size, but you don't have much credibility to do those acquisitions because of what the previous management team did. And I think he's navigated that dynamic exceptionally well.
Now, this is a very good sign when 361 and particularly yourself are giving big thumbs up here to what's going on at Prosus, because it's been a bit dodgy in the past. Are you of the opinion that, and I mean dodgy in that they never were going to go bust, and South Africans were never going to lose their money because of the Tencent underpin, but it did feel like the market was telling us that the management in the past was destroying value. In other words, they were negative. Now you're seeing this as a positive. What could the consequences of that be for ordinary shareholders?
So this is a pipe dream for the asset management industry, and I don't know if it will ever happen. But ultimately, what we would love is for them to split the company into two. The first part would just be a Tencent tracker, and the rest would be their e-commerce assets. Now, you can't have the e-commerce assets sitting on by themselves if they're not generating free cash flow. How would they survive? So they were extremely reliant in the past on the dividend coming from Tencent in order to keep that part of the business going. The e-commerce side of the business now is free cash flow positive for the first time. So there is this hope that over time that business can grow, scale up, have some good acquisitions made that increase the size, and eventually it could be its own separately listed business. And that way you would also unlock the value that's inherent in the discounts to NAV, because it wouldn't trade at anywhere close to the current discount to NAV. I think there's a lot of reluctance from the Naspers and Prosus board to entertain any kind of that thinking, but you never know. Maybe that was just because they were aware that e-commerce couldn't stand by itself in the past, but maybe by 2028 it's big enough to do so.
And at least it's now showing the right kind of signs of moving in that direction.
Yes, definitely. At this point in time, though, your returns are still going to be largely driven by what happens with Tencent. So they can be executing as best as possible on the e-commerce side of the business. But if you get new regulation in China or some kind of geopolitical fallout and Tencent does poorly, you're still going to do poorly as a Naspers Prosus shareholder.
So owning these shares, which virtually all South Africans do, you have to keep a close eye on China and what goes on there.
Yeah, without a doubt. I don't think a lot of South African investors are quite as aware as just how much what's happening in China impacts their portfolios in South Africa.
But it is on the upside, and perhaps 2028 or thereafter, you would see that spin-off. There is a growing presence now in Latin America, or Brazil and India, if you like. India does seem to be quite a big slice now of the whole Prosus story.
So for me, what I struggle to get my head around about India, and specifically their desire to create an Indian ecosystem, is that a lot of the stakes that they own are minority stakes in businesses. So how do you quite achieve those synergies that you set out to do so when you aren't necessarily able to share the data across the businesses, because it's not the same owners, it's not the same business. So I think that's a bit of a struggle, but the Indian economy is growing rapidly. So these minority stakes could be worth a lot more in the future than what they are worth now. But the difficulty, I guess, is that everyone knows that India is the next big, China, for example. And when everyone knows it, you get a flood of capital and valuations become very expensive. And if you don't make the right kinds of acquisitions, you end up risking that you overpay for those acquisitions, and your returns from that point forward aren't great.
The whole story at Prosus and Naspers started around the year 2000, when you had Koos Becker and Antoine Roux traveling around the world and doing what they called throwing mud at a wall and hoping some of it stuck. And they threw mud at a little company then called Tencent with only 30 people, and my goodness, did that stick. Are they still doing the same kind of thing? Are they throwing mud at the wall in, say, India or other parts of the world, given that they are entrepreneurially thought? Or has it now become very much an execution? And what I'm getting at here, in the past at Naspers Prosus, we got the feeling that it was growth at all costs. Now, from what the new CEO tells us, it's growth, but you got to have profit with it.
Look, I think making one of the best acquisitions of all time in Tencent is something that happens very rarely. To have it happen more than once is extremely unlikely. And that's not just one of the best acquisitions in a South African context. That's one of the best acquisitions across all markets. It's unbelievable, the returns that they've made from that. And I don't think that a listed vehicle is necessarily the right place now to make those sort of bets. And I think that's what the management team has realized, they need to be more deliberate with their acquisition strategy. So companies that are already relatively big, that already have scale, but that they have an edge being owned by Prosus and Naspers. So that's why the food delivery strategy makes sense, because they have their IP around food delivery and what works and what doesn't work, and how they're able to plug it into their own systems, and maybe their efficiencies on in the back office where orders can be dealt with by more and more AI that they've adopted. Whereas if that asset's owned by someone else, there might not be any kind of competitive advantage to owning it.
I saw that as well. I did ask in the press conference yesterday of the CEO, who keeps talking about execute, if he could give us examples of how he has actually been directly involved in this execution. And he gave quite a long list, but at the top of it all was bringing people together. He says iFood this year has had more than 100 group companies visit them to get an insight into what's going on the AI side. So it does appear as though that too is this integration. The air miles must be astronomical, but this integration is a very big difference and a big change from the past. Is it something that we'll see on the bottom line, though?
So, look, a lot of things that companies do, you don't necessarily see the upfront benefit, whether it's on the bottom line or even in terms of driving revenue growth. But before Fabricio joined, the business was extremely siloed, and the people that were operating in one part of the business had no idea what people in the other part of the business were doing. And it's interesting because they did have this AI lab within Prosus that could have warned about what was coming in terms of AI, and yet the old management team bought one or two businesses that had their fortunes directly impacted, and negatively so, by the growth in AI. So to have these different teams within Prosus meeting and discussing what's going on, you hope that some of these blind spots are removed, and maybe it doesn't directly translate into improved profitability up front. It might result in just generally better decision making overall.
He couldn't resist a little dig at the old management when he said that he's on a plane every week. He personally goes off to some part of the world. He doesn't sit in an office in Amsterdam and wait for the information or the data to come into him. So it does seem like there's a bit of a revolution there in culture.
I definitely think things have been reinvigorated, and there just seems to be more energy from everyone I've interacted with at the company.
What about here in South Africa? He had good things to say about Takealot, and how Takealot is, the CEO of Takealot said we wouldn't have been in profit, or certainly not to the degree we are, if it weren't for the integration now that we're getting, or the help we're getting from other members of the group.
Look, one of the big drags on the SA business is that they had a business, Superbalist, which they've now subsequently sold. So they've been left with Takealot, which I think would be a better business for them to get to profitability, or an easier business for them to get to profitability. The South African economy is not growing, and you've got more and more new entrants, especially in terms of retail. So if you have a look at ShopRite Checkers, they're now rolling out general merchandise on their 60/60 platform. You can order like bras, for example, and have it delivered on the same day. You've now got the entrance of Amazon in South Africa. They are a formidable competitor as well. And the rebranding of some game stores in South Africa to Walmart might also indicate that Walmart's willing to take a larger, more active approach in the South African market. So I don't think that it's going to be easy for them. Takealot. The fact that they've gotten the business profitability to improve is a great achievement, but it's not going to be easy going forward, even with their scale. And I don't think that these e-commerce only type of businesses have the best economics either. The good thing for investors is that it's so small. It's a rounding error in the overall net asset value of Naspers and Prosus that, if it was to be sold off or shut down, it's not going to make any impact on the investment case. But it is a very tough business to operate, and they've done, I guess, as best as they could hope for.
Stephen, are there other companies in the group that are identical to Takealot? In other words, that Takealot could learn how to beat Amazon with? And I ask this because the only media business in this entire group is also in South Africa. I guess that's legacy, but they seem quite attached to that too.
Look, if you think about the media business, there also might be political reasons why they need to remain attached to that. It might not be a pure profit motive. I think that they need to think very carefully in terms of how they treat some of the South African businesses, especially if down the line they needed to go and ask Treasury or SARS for some sort of dispensation. So I think that's, I think that might be the motivation behind some of these South African businesses. If they were of sufficient scale, I mean, maybe they would unbundle them to investors like they did with MultiChoice. That was a business that used to be within Naspers, but that was a huge business that had enough scale that it could be a separately listed entity. If Takealot was big enough that it could be separately listed, maybe they would unbundle it as well.
But are there other companies around the world that are similar to Takealot? In other words, that they will be benefiting from this environmental or economies of scale that Prosus is seeing globally?
Sure. They've got eMag, which is, I guess, a similar type of business, but it also was probably the worst performing business in this set of results under competitive pressure. They're not easy businesses to run, and the economics of them aren't fantastic either. So if you think about, like a classifieds business, it's very high margin with very low working capital. You're not buying any of the goods. You're not holding them on your balance sheet. You're just earning a fee on connecting buyers and sellers. So the economics of the business are significantly more attractive. Whereas running a business like Takealot, the CapEx requirements are huge in terms of having the facilities. Then you have to stock those warehouses. And then by the time you've sold the goods, you're making very low margins. So you got to have significant scale. I think everyone looked at Amazon in the US and thought this is a fantastic business, and try to imitate it. But that's not actually what drives most of the upside in Amazon. It's their cloud business, AWS, which is a much better business.
So what's Amazon doing in South Africa then, if actually the business we all know of distributing products is not really a great business, as you've put it? Is this somehow feeding into their international chain? And what does that mean for Prosus?
It is a bit of a head scratcher why Amazon decided to open in South Africa, because, as you know, Alex, the GDP growth in South Africa has been really poor, and retail does well when GDP is growing and doesn't do so well when GDP is stagnant. So I'm not quite sure why Amazon would want to come to South Africa. I mean, it's a small market relative to the other countries that they operate in. And even if they took significant share from the incumbents, it would still be a meaningless number in their lives. There was a stage at which a lot of these offshore retailers were coming to South Africa saying that Africa is the next continent of growth, and South Africa gives them a foothold in that story. But the different countries in Africa are so different that you don't really get any benefits of scale from having a foothold in South Africa. And we've seen it with our own retailers that have tried to move into Africa and the struggles that they've had.
It is interesting that Walmart has not managed to get a grip, even though it's been here for many years already, and that Checkers / ShopRite continues to get stronger and stronger. Now with Amazon taking on Takealot, it looks like a very contested space.
It definitely is. I mean, it's good for the consumer. If you have a look at some of the specials you can get on Amazon, you can get 30% off daily essentials. So pretty much like all your household cleaning goods, etc., 30% off. No one can compete with that kind of pricing. Obviously, some of the retailers will have promotions now and then, but not off the entire basket, which is quite something. So I can't imagine they're making any money at the moment, but it makes it more and more difficult for everyone else.
And I guess in America, they'd say, well, here's a couple of $100 million. They won't miss it. Use that to crunch the competitors in South Africa. Good for the consumers, and long may it continue, I suppose, from where we're sitting. But for a South African shareholder, for your average South African who's invested in the stock market through their retirement funds, through their pension funds, through unit trusts, or indeed directly through Naspers Prosus, what is your big takeaway for them in the financial results that we've now been provided with from these by this group?
I think the big thing is that investors are much better off in Naspers Prosus today than they were a couple of years ago. I think that the management team are going to make the right decisions to unlock value for shareholders, whether it's by driving improved profitability and revenue growth in their existing assets, or finding assets that strategically make sense within the stable, as opposed to just buying stuff that has no connection to the existing assets. I also wouldn't be too concerned. You mentioned earlier that it makes up 17% of the top 40. Most asset managers benchmark themselves to the caps fix in South Africa, and that weighting fluctuates between 10 to 12%, depending on when rebalances are in the index. And I think that having 10 to 12% in the portfolio is not undue concentration risk. I think that it's one of the best assets on the JSE and will continue to be so for a significant period of time. I would be very comfortable having my money, and I do have my money exposed to Naspers and Prosus.
And if you didn't have any exposed to them at these prices, given that they've had a good run over the past year, something like 50%, would you be buying today?
I think the biggest difficulty for a lot of investors is that their investment time horizon is not long enough. And, they buy shares and then they go down, let's say 15% from the time they do so, and they worry that the circumstances of the company have changed. Now, the big difference in a lot of South African companies is that we haven't had much economic growth. So when you buy a share and it's overvalued, it's so sensitive to that valuation because the earnings aren't coming through. So you can see lots of shares on the JSE have been range bound for many years. That's not the case with Naspers Prosus. I think there are many years of double-digit growth ahead for Tencent, and that the discount to NAV provides you a bit of a margin of safety at the Naspers and Prosus level. So always reluctant to give out exact recommendations on these kind of calls, but I think it is one of the better investment opportunities out there, and we have been adding more exposure to Naspers Prosus in our funds.
Stephen, what is that discount to net asset value? In other words, your margin of safety, roughly?
Sure. So it depends at which level and which company, and the different definitions of how people measure it. But roughly at a Naspers level, it's about 40%.
Wow. So you're buying Tencent shares for 60 cents in the rand through Naspers.
Well, it's not just Tencent, so there's all the other assets as well in that discount. But yes, a large portion of it is Tencent.
Okay, so let's just clarify that. What is the discount to Tencent at the moment in the shares?
I don't have the exact number offhand, but I would guess that it's probably close to 35%.
But that's still, as you say,
no,
Warren Buffett would love
significant.
It. Yeah, Benjamin Graham, Warren Buffett, it's their kind of stock. You buy something with a deep margin of safety, and it's growing in double digits. So it does. I can see why you're enthusiastic about this one.
Yeah, look, the thing is, if you don't have a catalyst, then that discount can remain there for forever. So yes, there is somewhat a margin of safety, but if they, for example, let's say Just Eat Takeaway ends up being a disaster, I mean, that discount to NAV will widen, and it actually doesn't provide you with the the margin. If you believed that they were going to unbundle at a later date the e-commerce business from Tencent, then yes, there's definitely a huge margin of safety. But these discounts aren't always, and I don't think that should be anyone's base case, that they unbundle the assets. But these discounts often don't provide much safety whatsoever. I mean, you can have a look at Pick n Pay and Boxer now. Pick n Pay is trading at a discount to its stake in Boxer. People are going to evaluate Pick n Pay on its own prospects, and if they think that that business isn't going to do well in itself, it doesn't necessarily help buying the shares, even though it's trading at a discount to Boxer.
What do you think of that one as a parting shot?
I mean, the big thing is if Pick n Pay doesn't turn around its fortunes, and Sean has done an amazing job so far. It's still not an easy job whatsoever. It isn't an easy job. The problem is if they need further capital down the line, the way they'll do it is by selling Boxer, and then you end up getting less Boxer on a see-through basis as a Pick n Pay shareholder. So what you thought was buying Boxer at a discount ends up being actually getting less exposure to Boxer at a later date. So I think just my comment on the discount to NAV, why it doesn't always work out, that's the example. In terms of Pick n Pay, Sean's got his work cut out for him. I mean, good luck. It's going to be a very tough slog the next few years, actually mainly because we're in a low inflation environment, and low inflation makes it very hard for food retailers to generate revenue and pay their costs.
I know I'm just taking a wild, throwing a stone in the bush here, but with Walmart, we were so massive, getting more interested in South Africa. Would Pick n Pay not be prettied up for sale to Walmart? Does that not make a bit of sense?
Strategically, I can understand why it makes sense, but I don't have any ability to actually judge whether that would or wouldn't happen.
But if the Ackerman family is reducing its stake, as it has been doing, would that not point in a direction of not being long-term shareholders anymore? Or am I just making all of this up to try and get a bit of drama in an otherwise very pedestrian story?
I mean, my view with the Ackerman family selling down is that when Pick n Pay needed to raise capital, they had a rights issue, and the family followed their rights, which meant that they needed to find money from somewhere to pay for those additional shares that they took up. There's a good chance that they didn't have funding on hand and they had to obtain gearing or loan from the banks. And they might just wanted to have unwound some of that gearing by selling their shares that they'd taken up in the rights issue. They'd done really well. I think they ended up buying the additional shares at about 15 Rand and they sold them at 25. So it was a nice profit. But I think they just didn't want to pay the additional funding on those shares and de-risk their holding in Pick n Pay.
All right. So again, a very rational approach and a very rational conclusion there.
I mean, the other question you would say is if they believed that there was going to be an approach from Walmart, why did they sell their shares?
Good point. Yeah. Stephen Hurwitz, Portfolio Manager at 361. Fascinating. Thank you for shining such a bright searchlight on the whole Prosus story, which is so relevant to South Africans who are saving for their retirement or for their futures, or indeed investing directly in the stock market. I'm Alec Hogg from biznews.com.